Good day, everyone. We are continuing our series of trades here at sharptrade.com on the topic of money management. Money management being the mathematics of how you stay profitable after 20 trades, 30 trades, 40 trades. When you line up your trades in a trading career, how do you remain profitable? That's the overall topic of money management. And in this playlist or series that we have, we've talked about a few principles. First, obviously, always being risk. Never violate or go past any sort of risk parameters that you set up. However, I would say the principle that we're going to talk about today, because we already talked about risk, we talked about managing rewards and profits, we talked about a risk-reward ratio, how it relates to accuracy. But I would say today's topic is probably one of the most ignored. Money management as an overall topic is generally an ignored topic. People generally do not pay attention to the topic of money management when they get started investing and trading. You have to sooner or later because it's the mathematics of how it works. So they generally ignore money management. However, if you took the money management principles and said, what's the most often ignored principles inside of money management? I would say trade management is one of the top two. Actually, the two that are most often ignored are very much related. Analyzing your performance. Well, you analyze your performance because of trade management and what you do inside of trade management. So these are, the most ignored principles, and the topic of trade management's, one of those two. There's very little in the way of hard and fast rules when it comes to trade management. Very little. You know why? And very little information about hard and fast rules for trade management? It's because you have to be flexible. And that's what trade management concerns itself with, is how you are flexible. So it's not hard, it's impossible to just come up with a rule and say, inside of a trade, act this way. Because each trade is different. Markets are different. I've heard some people try to claim that all trading is the same in every market. Baloney. If you believe that, go from trading the E-mini to like lean hogs. Or trade the live cattle market and then go trade Apple. And then after that, go trade like a Forex cross. Markets are wildly different. And each has their own cadence and dance. Each trade, as you get in it, since we don't know the future, is going to behave a little differently. And so you have to know, and this is where skill and experience comes into play, you have to know how to be flexible once you pull that trigger and get into the trade. So you can't really come up with the rule, right, of what you do in every single trade because markets are different. Even inside the same market, trades are going to be different. Trade A is going to be different from trade B just because of the market conditions are just different. So you have to be flexible. So if you have to be flexible and there's skill and there's experience, you can't make a hard and fast rule. You can't. You can have, however, general principles of trade management. Principles will always trump a rule because principles are more malleable, right? Whereas a rule is just a rule and you have to follow that rule. So we would say that there are general principles to trade management. There is some discussion out there about trade management, but what we found is sometimes it's things like, well, always have a trading plan, right? When it comes to managing your trades, always have a trading plan. Okay, what does that mean? Always have a trading plan to me, while true and it's good counsel, to me it's just like one of those aphorisms that's just repeated, but there's no real meat behind it, quantifying it. You know what I mean? Always have a trading plan's like, if you're in a short-term trade, don't have a mental stop, always have a stop-loss order. Okay. Or, always cut your losses really quick, but prolong those profits. Very true. All very true. But there's no meat there. It's, it's about as helpful as, well, you got to buy low and sell high. It's, yeah, it's not like somebody's going to say, oh, that's what you do? You buy low and sell high? Well, Dan just gave me the keys of the kingdom. I'm going to go out and master the stock market because now I'm going to buy low and sell high. So when folks say have a trading plan, that's very true. But what does that mean? And we would answer that question of what does that mean by asking the question, to get to the principles of trade management, what should a trading plan consist of? Now we're getting to the meat of it. What should a trading plan consist of? Or really, not even just a trading plan, like something you write on paper, but what should good trade management consist of? What should you know about your trades before you ever get in your trades? That's critical. That is absolutely critical to understand. It's incredible to us how many times we'll hear of somebody, they throw some money into a retail trading account, they pull the trigger on a trade, now what? And then they'll start posting around the internet, hey, I got in this trade, what do you think I should do? And I'll tell you, I've run across that, and the answer some people don't think is kind, but it's the truth. I was in one particular venue I know on the internet, and somebody said, hey, I got involved in this trade, it's moved against me, what do you think I should do? And I basically said, I don't think you should be trading. And I sort of got landed on and jumped on. Because it's like, oh, that's not very helpful, And it's like, listen, if you don't know what to do when you pull the trigger, then you shouldn't be trading. And I was trying to be helpful. I'm not trying to be smug. I'm not trying to be arrogant. I'm not trying to be some sort of smart aleck. But if you pulled the trigger and got into a trade and then are asking everybody else on the internet of all places, what should I do with this trade? I mean, the answer to what you should do about trades is answered inside these principles that we're going to discuss right now about trade management. So I think the most helpful thing to do to tell a person like that is, I don't mean to sound mean, I don't mean to sound arrogant or anything, but should you really be trading if you don't know the answer to that question? And I think it's helpful to tell people that. Because if they just keep on getting in trades and then why did I do this? Or the one that I hear all the time. I got in this trade and it moved against me. Why did that happen? You know what? Because sellers were aggressive if that moved against you and you bought, and buyers backed up. There's never more sellers and buyers than sellers. That's just basic. That's a myth that's out there. But basically what happens is the buyers backed way up and the sellers got really aggressive. But it's like, well, there must have been some reason. If you're looking for that, that's not the principles of trade management. So if you get into a trade, if you have the principles of trade management, you're going to know what to do. It relieves a lot of the stress of trading. So let's switch over to some slides here, and we're going to talk just about general principles that you can keep in mind, and the main categories of trade management. We're also going to bring up a tool that you can use, and it's going to tie into another money management principle later. So let's jump over to some slides here on the screen.
So remember that as we go over this, these are general trade management principles. And I would say one of the very first and most important trade management principles is that of time. How long are you going to be in this trade? You should know how long you're going to be inside of a trade, or the time that you will be in that trade before you ever get into the trade. And I would ask, what methodology are you using to get into that trade? There's all sorts of methodologies that work and are profitable. Please do not believe that I am somehow here to say that Dan has the one profitable method of trading. No. There are almost as many profitable ways to trade as there are traders. There are myriads of profitable methodologies. But if you're using a methodology that methodology should be telling you your time frame. In other words, you could have a day trading methodology, right? Well, your day trading methodology is telling you what? Your time frame is 1 day. You're going to be in that trade and out of that trade in one trading session. And you should be keeping track of this. This is something that we're going to come back to. But you should be keeping track of how long, generally, on average, you're in your trades. And your methodology will tell you that. So how does this protect you? How does knowing, what your methodology says, how long you should be in your trades, how does that protect you? Well, have you ever heard folks who will be talking about, they got involved in some particular asset class, whatever it is, who it could be a stock, right? They get involved and they buy a stock. And it moves against them. And all of a sudden, the short-term trade is now, well, I think I'm going to make this a swing trade. Wrong. You're stepping outside of the bounds of your methodology because it moved in a direction that you didn't want it to go. You're violating a money management principle when you do that. If you bend the rules of whatever particular methodology that you're using, it's called style drifting. It's also referred to as standardization of deviations. You're deviating from your standard that has an implied edge. You should use the same methodology, and when you use that methodology, it will make sure that you don't do that. Because then what happens? Somebody says, well, I bought this stock and it moved against me, and it's not a day trade now it's a swing trade. And the next thing you know, all of a sudden, it's an investment. Oh, this is a long-term investment. I love the company. Well, they just deviated. So before you get in the trade, you should know, according to the methodology that you're using to trade, how long that trade's going to last. If it moves against you, then okay, this is a day trading loss, and I can accept that day trading loss. And you record that. You record how long you were in that trade. Time. It's vitally important to understand. Because also, if you're in a trade, let's call it a day trade, right? And this methodology of day trading, you're typically in a trade for an hour, maybe 2 or 3 hours, and you're zooming in on 2.5 hours and you really haven't made money, or you've only made a little bit of money, is it time to close out the trade? It can be. You didn't get that push, and we'll talk about that here in a second. But you didn't get that push in the time frame that you were looking for. And so, you should just know, typically, according to the methodology, the time frame that you'll be looking to trade, and do not deviate from that once in the trade. Also, price. The price of the asset. Once you pull the trigger, right, and you're up or down, this is very simple. Everybody knows this. They get involved in a trade, and it moves in their direction. Fantastic. Everybody watches that, right, as the trade is evolving. So price. Or they get involved, and the price moves against them, and they're down. And you're down on your particular trade. So time and price. Well, that seems a little bit vague, Dan. But if you marry this to the previous principles, and you're keeping track not only of how long you're typically in your trades, but what did we talk about earlier on in this money management playlist? Your risk-reward ratio. Now you've got some variables. You know that when you lose on a trade, let's say for every single contract that you have on, however many contracts it is, you lose around, let's just call it, just so that we can make the numbers easy to talk about. Every time you lose on a particular trade, you lose nominally $50. Okay, that's what you lose typically per contract. For every contract you hold, you lose $50. You know that you're, let's say, 65% accurate, and when you win on a trade on average, you win $60, right? So pretty cool. You've got some really good money management stats. Really good money management stats. Well, if you're in the trade and you're been in it time, go back to time, you've been in it for, let's say, 2 hours on a day trade, and it's moved against you $45, time and price, you know your risk-reward ratio from the earlier principles, you know what? It's looking like I just might have to dump out of this trade, accept my loss. So know your risk-reward ratio from those previous principles. When you're up or down, it's going to help you to know, do I need to take my profits? Can I let it run? Should I let it run? Or are we getting near this general area where it's time that I just need to be cutting this trade and getting out of it? And the third general principle of trade management, we would say, is that of flexibility. And we mentioned this very briefly when we were talking about time, but we mean like the volatility of your trade. The volatility, the push of what you're looking for. And I'll tell you, I was talking with a client of the Sharpe Report recently, and this principle just came to the fore in the discussion, and I thought of the illustration, and I'm going to use it here. When we talk about the volatility in trade management of the trade, it's sort of like baseball. Okay, Dan, you're going to have to explain this. How's it like baseball? Well, when you step up to the plate, you're looking at the trade, right? When you swing that bat and you hit the ball, right? It's like getting involved in the trade. You're committed now. You're the batter, you swung the bat, you hit the ball's taken off into the field. You're committed. Start running for first base. But part of baseball is when you hit that ball and that ball flies up in the air, you may be running your guts out. But you're also gauging what sort of push did I get on that ball. Am I going to need to just pour it on? Because I know as soon as I connected, I know that ball, I cracked that thing. I just cracked it. We've got 2 men on base. That ball is flying. And I am going to be running for first base. And yeah, I'm going to round and I'm going to make it to the attempt for second. Why? Because you know how you connected with that ball. Or you know when you connected with that ball, when you hit it, bam, it hit the ground, slid past the pitcher, and you're just eyeing everything up, right? And guys are scooping in, so it's like I got to pour it on, and I hope I'm going to get a single off of this, and just pour it on and run as fast as you possibly can, overrun the base on first. It works the same way in trading. When you get involved in a trade and you're gauging time and price, those earlier two factors, how much has it moved in your direction? Price. How long have you been in the trade according to the methodology? Well, then you're going to know some flexibility. I've gotten involved in trades I thought were excellent setups. Beautiful setups. And when I got involved in the trade, I didn't get that push. The ball, when it connected to the bat, or when I got involved in the trade, the market just sort of didn't really move. So it's sort of like, as soon as I hit that ball, so to speak, speaking in metaphor, it hit the ground and just started rolling. I'm not going to get a grand slam here. And some trades you'll get involved in, and boom, they move in your direction. Great, let it go, run, right? Run to second, run to third, let it go. So that's the other thing we would say is you have to gauge the volatility of the trade once you are inside the trade. The speed really is what we're talking about. The speed of the trade. Is it really moving in your direction or moving against you? Could be moving against you, right? So these are just the general principles, and we would also say that you need to be recording this stuff. There's some things you need to be recording during each trade. Now, you see it here. We're going to provide the link in another video in this money management series. But this is an image of a spreadsheet that we're going to basically draw up for this money management playlist. You can view it. The link will be on either the entry later on. We're not releasing the link right on this video. But you'll be able later on in this money management series to go to the link and look at a spreadsheet. And it's sort of like trade management, right? As well as some other money management principles will be recorded on here. And you can record these things. And as you get to know your numbers, you're going to know things like time. I've been in this trade for an hour and it's moved a little bit in my direction. I'm not really close to my maximum reward price, right? I'm not really close, but I'm not to the maximum, but I'm getting close. Been in this thing for like an hour and a half. It's a day trade. I'm typically in day trades 2 hours. It's stalling. It's not really moving more in my direction. It's not, I'm not getting that volatile push. Is it time to take your profits? Okay. So those are some just general principles we would talk about when it comes to trade management. Things that you will need to record, like on a spreadsheet here, and some general principles to keep in mind. And we will continue on and discuss more principles of money management further in this playlist or series. But for now, that has been what it's always been. It's simply been our thoughts, not yours, for whatever the heck date is. As always, stay safe, trade well, and remember that love doesn't cost a dime.